I can see piles and piles of books आपके पीछे. You've been reading a lot.
Yeah.
So tell us a sum and summary. With so much of analysis you've done, tell us 3 stocks to buy. We'll keep it very simple. You give me 3 stocks, one question, and then I'll let you go to a meeting.
See, stock recommendations not doable because of regulations, but I think look, we have priced in most of the negative. That's one, and I think whatever micro details you need to know about India is already known in public domain. There's nothing new to analyze just yet. As things stand, we don't know all the information regarding tariffs, etc. But if we were to take a broad macro call, I think US dollar is likely to depreciate going forward. You're already seeing the ramifications of that in commodity prices, in gold and silver prices. Also, it's likely that you'll see an appreciation of the Japanese yen or the euro. And that is also going to bode well for the emerging market as a whole, and India is a part of the emerging market basket. So from that point of view, I would tend to believe that given that FY26 earnings are going to be better, we have priced in, we have fallen from 26,000 to 20,000. There is not too much of negatives from here, and that's how I would look at it. Secondly, I would believe that consumption is the big theme, so you could buy into any of the discretionary consumption names or even the FMCG now, given that rural economy is on the revival path. And that's going to be the next big theme for the markets for FY26 per se, according to me. And you could buy into motorcycles, and of course, there's likely to be revival, let's say 2 to 3 quarters down the line. So that's one. You could look at white goods. You could look at hotel stocks. You could look at airlines. Health insurance. You could look at apparel, retailing. So I would believe that consumption is the next big thing, and obvious names are there, for you to reckon. And secondly, I think that rate cuts, in India would be far more possible now. And given that we are already estimating close to around 50 to 75 basis point cut in the current fiscal 26. I think all these things are broadly very positive for equity market as a whole. And we have also seen the mutual fund data flows come for the month of February. Not that damaging. We're still sitting with something like 32,000 crores worth of net inflows, both lump sum and SIPs. And the IPO market has cooled off. That's helping matters at the margin in terms of what the leakage in the system were on account of private equity exits, IPOs, QIPs, preferential issues. That was the main problem for fiscal 24. So from all these points of view, I would believe that broadly we are closer to the bottom, if not the bottom already seen.
Interesting. Manish, I'm wondering, whatever happened to the entire energy transition theme, because consumption, like you were just highlighting, seemed like very 2 years back. For the last 1 year, all that you've heard is energy transition. Seems like you're switching back to consumption now.
Absolutely. So, see, energy transition is a good theme till 2030, but valuations have to be in sync. I think, and evacuation and generation have to go hand in hand. Today, the problem is that there are certain PPAs that are not getting signed because of evacuation problems, and the difference between demand for day power versus the demand for night power. There's a mismatch, and all of this is leading to some slowdown, according to me. And maybe it's not visible as yet, but valuation is something really not very comfortable as we stand. So yeah, things will be okay from the next 3-4 years point of view, but not just yet. I think this is a theme which has gone back in the background, and it will bite some time, both on account of time correction as well as price correction.
Are we in for double-digit gains from here for this calendar year? Do you think we should expect double-digit gains?
Nikunj, I think, see, Nifty 50 is broadly going to traverse something like 10 to 12% EPS growth. So from here, 22,000 to expect 24.5 to 25,000 between December 25 and March 26 is certainly not out of place. So from that point of view, a 10 to 12% sort of a Nifty gain is purely doable. And if you add a bit of a stock selection, alpha here and there, 15% on your portfolio is doable even for fiscal 26. I am not in that camp who believe we are going to be in a negative year and everything is very overpriced on tariffs, etc. But keeping everything in mind, this differential tariff is not so much of a problem as far as India is concerned. Differential duties 5-6% on a $150 billion turnover between US and India. You're talking about $7.5-8 billion worth of impact at the worst. Of course, certain sectors, categories would be more impacted, like your agriculture, like your, some automobiles here and there, but that's about it. So, double digit, nifty growth is even possible for fiscal 26. That's how I would like to believe. I'm not in the camp who believes a negative this year.
Right. Good morning, Mr. Sonthalia. Cheryl also joining in the conversation. I wanted to get your view on the metal sector because that one also is one of the sectors which a lot of them are betting on, given the fact what is happening in China. The government is going ahead with their consumption boost, should bode well even for the metal counters globally as well. But what's your take? How should one actually read into the sector? Because it's very heavily dependent on what happens across the globe.
So, as I alluded to in the beginning, that I am in the camp who believes that the US dollar is going to fall and going to fall something like 10 to 15% over the course of the next 12 months. And this is on account of whatever policy measures are getting taken out there. This will result in, already the base metals doing quite well. The bullions, gold and silver is doing quite well. Other currencies like yen and euro likely to appreciate. So from all this point of view, whatever is pegged to the dollar, will tend to appreciate if the dollar depreciates. So from that point of view, all commodity stocks, including metal stocks, are likely to see a price inflation going forward. And mind you, China is giving us stimulus. You have the Eurozone talking about expansion of the fiscal deficit. So the growth mantle of the globe shifts away from the US to the Eurozone and China once again. And once the growth mantle shifts to China, of course, that's going to be positive from the demand point of view as well. So things are definitely improving at the margin as far as China is concerned, notwithstanding the trade tariff issues that loom large. But even with that, given that the big macro call is the dollar is supposed to depreciate, and if one believes that if manufacturing has to go back to the US, there is no way manufacturing can go back to the US if the US dollar remains very, very strong. So from that point of view also, I think US dollar has to depreciate for manufacturing to go back to the US. And all of this, commodities stand here.
Manish, up till now, we are putting a brave face. Everyone is like, yeah, US has gone down, dollar will go down, India will benefit. But there would be a threshold beyond which it will start hurting the world. Whether it is leverage, whether it is mark-to-mark losses, whether it is hedge funds, or whether it is ETFs. When such large concentrated trades in the world, when they reverse so sharply, the unknown effect of that is actually very brutal for financial markets. More than anything else, I'm actually worried about that.
See, I think everything has a place. So emerging market will have their place. You'll have the developed markets have their place. All of this deleveraging. So so the whole point is that whether the de-dollarization of the world, which has got started, is going to gather pace or not gather pace. I am of the belief that de-dollarization of the world and de-pegging of fiscal policies in emerging markets with a vis-a-vis the US dollar is likely to happen. There's nothing in the micro markets to understand. Everything has to be from a macro point of view. And the big call you have to take from a macro point of view. And that is also going to impact India per se. So given that, large cap, mid cap, small cap, we are not talking about when the valuations are extremely elevated. You're talking when the valuations are really corrected. Flows have been negative. You can jolly well play with the momentum on the downside. But having said that, I would believe that more than all the negatives are already priced in the stock prices, as far as India is concerned. And if we keep a lid on the QIP issues and the preferential issues and the private equity exits, I think FI outflows and DI inflows would broadly match. That would again provide a floor to the stock prices as far as India is concerned.
Manish, what I observe is that, when you talk about consumption, your tilt is still pretty much towards the entire premiumization or urban consumption theme. Would you look at maybe some bottom up stories? Rural consumption seems to be kicking back in. Should some of those staple plays, which are directly linked to rural exposure or rural markets, also be looked at?
There has been a saving of 1 lakh crore in the budget. And that is saving on account of income tax. There's not been too much of a cut in GST. So from that point of view, out of 7.5 crore income tax filers, return filers, you have around 6 crore people who have an income of less than 12 lakh rupees. Now, these are the 6 crore people who are broadly going to benefit. And these are the guys who don't have to really be very worried about your roti and kapda, which is your food and clothing. So that is the big call, that discretionary spend is likely to benefit more than FMCG. And of course, our finance minister has also alluded to the fact that GST rates are also headed on the downside. So from that point of view, even FMCG at the margin will benefit. And rural economy, in any case, is coming back from the lows. And that is also going to be beneficial for the FMCG place. So all in all, the entire consumption basket is likely to benefit. Maybe you're not going to see the impact only in the March quarter, but next 2 to 3 quarters, right? The positive impact of this is going to be felt because there's going to be a multiplier of this 1 lakh crores. According to the theory of marginal propensity to consume, if you save 20% of this 1 lakh crores, the multiplier is going to be 5 lakh crores. If you save 25%, that's going to be 4 lakh crores. If you save 30%, then that's going to be 3 lakh crores. And mind you, next year again, you have the 8-pay commission recommendations about to come in. And we are talking about 1 crore plus government employees. And, the fitment factor which is being talked about is around 2.5 to 2.8. Of course, that would again mean the salaries of government employees will likely go up by 25 to 30%. So again, from that point of view, we are looking at a situation where consumption stocks are likely to benefit. The benefit is going to be more pronounced, according to me, in discretionary names. And both urban and rural discretionary names are likely to benefit, whether it be tractors, motorcycles, or white goods, or so on and so forth. They are likely to benefit. Rural retailing and all of that, as well as FMCG companies, where there is commensurate growth, because the FMCG sector is lacking growth and elevated valuations. If the growth comes in, maybe the valuations will find a floor and maybe even move up from there.
Okay. Manish, fair enough. But then what happens to capex stocks? Government spending there also will pick up. If numbers are anything to go by, they were down because of election spending. And for next year also, the uptick in GDP in capital expenditure is 10%, which is quite a decent number, right? So what happens to that end of the market? If someone has to choose, let's say, between Build India and Buy India, which is a better theme?
So, Nikunj, you are right. Government is doing its bit on capex. They have spent 3.1% of GDP on capex, 10 lakh crores for fiscal 25, 11.11 lakh crores for fiscal 26. Capital formation has gone up from 26% to 30%. That's about it. I mean, we can't expect the government to do almost all the heavy lifting. Private capex has also to come in. So, it boils down to not the problem about capex, it boils down to valuation. Capex names which started with 20p and you elevate those valuations to 70, 80p and they have corrected to, let's say, 50p, it's still over. The theme stays good, the growth stays good. That is the major problem in the capex stocks, the capital goods, the power, the renewables, the infrastructure, roads, railways, defense. They are suffering from a problem of valuation. The biggest problem in Indian markets today is nothing but the valuations. Each individual sector, company, stock, if the EPS growth of the Nifty is growing at 10%, you can't really be buying into companies, sectors, industries, and more than 3 PG. It doesn't stay. We have seen that anecdotally. So the problem of the capital formation stocks, capital goods stock, infrastructure stocks is only the valuation. If the valuation is conducive, even those stocks will do.
Okay. All right, Manish, really appreciate your time and thank you for joining us. Well, it gives me great pleasure now to bring on board Mr. Vivek Koadiangam, Chairman and Managing Director of REC. And REC, to introduce the company,